today is going to be a great video. Okay, we're going to go over crypto news. We're going to go over Genesis, Circle, FTX, celebrities entangled with FTX, regulation, insider trading, El Salvador doubling down, and more. So, saying that, welcome to the Wheelhouse. So we've gotten 2,000-3,000 more subscribers in the last month or so, and I wanted to take a moment to say thank you and that I'm grateful for everybody, new subscribers and previous subscribers, of course. And I want to let you know that I'm always here for you. You can ask me questions in the comments. You can come in the Discord. You can tag me. You can DM me. Okay, it's free to come in there. Whether that be for scalping or long-term investing or just tips and how to navigate the markets the best that I can and just be there for you. And that's what's great about our Discord. It is kind of like a support group where people, go through it with you and they share ideas and they grow together. They share charts. If you want to upgrade, I have courses, one-on-one coaching. I have trade alerts, the previously recorded Wheelhouse Wednesday group trainings, and we do have a Black Friday code going on, which is the biggest code we ever had, 50% off. It's Black Friday 50. I'll put it on the screen right now for you, and it's all caps. But essentially, I just wanted to take a moment and say thank you, that I'm grateful for you, and I really appreciate you when you like and you subscribe, and I really appreciate you watching all the way to the end. Many of you don't know that it takes a long time to get a 10-minute, 20-minute, 30-minute video out. Sometimes it can take 7-8 hours to get a 30-minute video out. The other day when I made that video, 1.4 trillion lost in the crypto bear market, that took me almost 20 hours to make. Between transcoding, rendering, filming, editing, exporting, uploading, research, it takes a long time to do that for you guys. So watching all the way through is great. And if you've been on the channel for a long time, you know that I dig really good, tasty little nuggets and mental tacos deep in those videos. So again, I want to say thank you. I appreciate you. Who loves you, baby? Wheelhouse loves you, and so do I. Let's take a look at the charts, which are moving in crypto. Look at Doge, Solana, Avalanche, Apes up, Aave, Matic, Mana, Ethereum. I mean, it's moving. Cardano, Link is back up a lot. So, we're going to go through a lot. We're going to have some fun. Let's just take a look at the crypto market cap, and then we'll look at the bubbles and then get into some news, okay? All right, so here we are. Today's crypto prices by market cap. The global crypto market cap is at 834.41 billion, and that's good. It's been bouncing up and down. It went down to 794 and back up to 840, and then it came back down around 788, and today it's back at 834, so that's better. Let's look at a couple of the prices. Okay, Bitcoin's kind of been in that range from 16.2 to 16.7. It's right at the top threshold of that right now at 16,648 at time of recording. Ethereum's at 12.22, BNB's at 3.09. Ripple's about 41 cents, Dogecoin 9.5 cents, Cardano 32 cents, Matic 86 cents, Polkadot 5.34, Solana $14.43. Let's take a look at the bubbles, the crypto bubs. That's what we like to see, green on the screen. So look at that, Doge, 15.2%. Not bad, not bad. We got HT up 18.4. I mean, everything is looking pretty green, out there. There's a few. FTT's down. Zcash is down, Litecoin's down, but pretty much everything's up, and that's good, right? So let's take a look at some of the crypto news.
All right, let's catch you up on the top stories. First up, Genesis could be inching closer to bankruptcy. The crypto lender just hired investment bank Moelis & Company as a restructuring advisor. The bank will reportedly help the firm explore several options to stabilize its business, including a potential bankruptcy. The crypto lending unit of Genesis faced a liquidity crunch in the aftermath of FTX's implosion. thanks to $175 million in assets that the lender had on the exchange. Those frozen funds led Genesis to halt customer withdrawals on its own platform. And then as recently as this week, the company reportedly warned that it could face bankruptcy without new funding. Next, despite the recent turmoil in digital currencies, El Salvador is doubling down on its vision for a crypto economy. Lawmakers there are considering a bill that would create a regulatory agency focused on digital assets. It would also create a legal framework for public issuances that use digital assets. Basically, that means it helps pave the way for Bitcoin-backed bonds. These so-called volcano bonds, as they're known, have been a promise of the country's president Nayib Bukele since last year. He's been instrumental in El Salvador's adoption of Bitcoin as legal tender, and he hopes to raise $1 billion with these bond issuances. Last, New York State lawmakers are moving forward with their own crypto regulation. Governor Kathy Hochul signed a 2-year moratorium on new proof-of-work mining projects in the state unless they use 100% renewable energy. Now, this doesn't affect Bitcoin mining operations that are currently up and running, but if they need to renew their permit, well, they won't be able to for the next 2 years unless they convert to renewable energy. The new law is part of efforts to cut down on the state's carbon footprint, but crypto industry experts say the law could have a harmful ripple effect across the U.S., which accounts for nearly 40% of the world's crypto mining operations. Okay, on to our main story. The implosion of FTX sparked renewed scrutiny on digital assets and launched debates over how little oversight there is for crypto businesses and investors. A report from the Wall Street Journal picked through public data from Argus to find that FTX's sister company, Alameda Research, hoarded several cryptocurrencies before their public listing on the exchange. Details of this practice led some to question whether this was insider trading. Crypto market manipulation, like insider trading, has gotten more attention this year than ever, but it's still rarely prosecuted. Crypto World took a look at what makes these cases so hard to pursue.
Back in July, the U.S. Securities and Exchange Commission charged a former Coinbase employee in crypto's first ever insider trading case. The case was seen as a huge step for the agency in its attempts to regulate crypto through enforcement action, and many thought it could signal a wave of crypto insider trading cases to come. But heading into the end of 2022, that wave never happened, despite several studies suggesting that evidence of insider trading is hiding in plain sight right on public blockchains. A study from the University of Technology Sydney, published in 2022, estimates that for every 100 token listings, there were about 10 to 25 instances of insider trading activity. In traditional markets, that number is more like 5 out of every 100 earnings announcements. So why aren't there more prosecutions of insider trading in crypto?
There hasn't been a judicial determination that any crypto asset is a security yet, other than some lower court opinions that haven't definitively defined or definitively found that. So in terms of who is policing it, it's a little different right now. There's some uncertainty.
To sort of stoke that fire is also the perception that crypto markets are lawless. So you have a lack of regulation in a sense, or not very clear regulations, and then there's no consequences for misconduct. So it's hard to, as a participant, if you have insider information, you can sort of sit there and go, hey, I'm actually able to trade off this and profit quite easily.
So how does crypto insider trading work, and how can the industry and regulators fight back? Insider trading occurs when someone buys or sells a security based on material, non-public information. An insider trading conviction could mean serious time in a federal prison and up to 7 figures in fines.
You are an employee of a company or a project that issues tokens. You know there's going to be a major announcement, like an acquisition, like a merger, like an upgrade, like a technical development, and you buy ahead of that too.
One such announcement is a token getting listed on a major crypto exchange. That alone can help boost the price of a digital asset. Traders who know about those listings can buy in ahead of time on decentralized exchanges. In traditional finance, that's almost like being able to buy a stock before the company goes public.
I would sort of identify it as like the risk exchanges are the ones where you can have those value propositions. Your smaller secondary exchanges, or like low tier exchanges in a sense, where you don't have a lot of liquidity, you don't have a lot of volume. Getting a cross listing on those exchanges aren't as beneficial as, say, your major exchanges like Coinbase, Binance, FTX, where if a listing on those exchanges, you increase the liquidity for that token in the markets. and then as such, you can just do a better price discovery.
Decentralized crypto exchanges often don't have what's known as Know Your Customer or KYC rules, which require customer identities to be verified. What's different about insider trading in crypto compared to Wall Street is the public nature of blockchains. All trades on DeFi exchanges are entered into public ledgers.
Yes, it is an area where you would think that the government can track that. In terms of determining what the schemes are, that's sort of where it's lacking now, where the government hasn't moved. But once they have a theory, it's very easy to go and look and see if someone bought something and when, and then they could build their case from there in terms of determining, did this person have access to material non-public information in advance of those transactions?
Because crypto is so new, a lot of the guidelines are still up in the air. There's no clear definition of what material non-public information means for crypto, and whether these cryptocurrencies qualify as securities or commodities remains under debate.
Seems that Sam Bankman-Fried and his colleagues were part of those counterparties. Wow.
Shonali, the issue a lot of people are going to have is, if this is happening at FTX, is it happening elsewhere?
Take us back, if you could, to when you first got the call from Sam and you first had a chance to look at the books. Because I think a lot of people are still trying to understand exactly what happened here. How much of this was about commingling? How much of this was about terrible marking of the books? What did you see?
Yeah, I think I got a call from Sam 48 hours after I made the tweet, but then we got our team on it. It was pretty clear pretty soon that there's misappropriation of user funds. The user funds are gone. At that point, clearly that he lied to his users, his investors, his VC investors, his employees. At that point, I thought I couldn't, whatever data that's in the data room, we couldn't trust anymore. So it was quite hard for us to do that due diligence. So we didn't go very far.
Do you think he understood what he was doing?
But I think it will be very, very clear that Sam knows that he was using the user funds to do trading for Alameda.
How much of the funds can they not locate?
I think if you look at the declaration by John J. Ray, remember this is the man who oversaw the liquidation of the Enron bankruptcy as well to try to recoup funds. He had very strong language. He said that there was a complete failure of corporate controls, and he also cited concentration of control in the hands of a small group of people. Tracy Alloway of Bloomberg also pointed out some really interesting details in the footnotes of this filing that showed you loans that went from Alameda had gone to certain individuals, and certain amounts of this money was used to pay, according to this filing and the declaration from John Ray, to pay for personal assets of Sam Bankman-Fried as well as his deputies. So it is definitely worth a read, this filing.
Are those Twitter posts going to be a problem, do you think, Shonali?
In this filing, it said that Alameda made loans, we think, to the FTX executives.
They named him by name in the filing, and the amounts.
If Alameda wound up getting consumer money from FTX, this is like an FTX financing FTX executives in some kind of circular way.
Yeah, it's a lot to take in, right? Lots of news going on out there. We've learned some new things about the structuring, the creditors, where the bankruptcy will be held, and there's just so much going on in crypto around this particular developing story. It says right here, trouble in the Bahamas following the FTX collapse. locals say they are having to contend with vacant apartments and the loss of job opportunities once provided by the collapsed exchange FTX. And here we have another article that says FTX stake in US bank raises concerns about banking loopholes. The chairman of the Rural Bank, Jean Chalopin, also happens to be the chairman of Deltec Bank, which has Tether and Alameda both on its client list. And crypto lender Matrixport seeks $100 million in funding despite lending crisis. Bitmain-backed crypto lender Matrixport is the other half of a new funding round targeting a $100 million raise. And crypto Twitter reacts to Binance CEO's deleted tweet about Coinbase's Bitcoin holdings. Coinbase CEO Brian Armstrong indirectly addressed CZ's tweets as FUD. So CZ basically just pulled up the article asking the difference between two different timelines, two different articles that were 4 months apart, and because it was causing FUD, he took it down. I saw an interview with him, and he didn't mean to cause the FUD, and he wasn't talking bad about any of his peers in the space, but he took it down because it was people were reading it that way. And you knew this was coming. American regulators to investigate Genesis and other crypto firms. Alabama and several other U.S. states are investigating alleged securities violations and connections with retail investors. So, comparing the 2022 bear market to the 2018 bear market. Though around 3 million Bitcoin flooded exchanges back in 2018, unprecedented amounts of Bitcoin have left exchanges through the 2022 bear market. Not all bear markets are created equal, and the same can be said when comparing the 2018 crypto bear market and the current bear market of 2022. Following the peak of the bull run in December 2017, Bitcoin's price dropped below 10,000, and what followed from January 2018 to Q4 2019 was a large inflow of Bitcoin onto exchanges, starting with around 1.7 million Bitcoin on exchanges in January 2018. By the end of 2019, exchanges held an estimated 3 million Bitcoin. That sounds like good news. And FTX gets approval to pay critical vendors, can redact creditors and customer list. The court filing revealed that the bankrupt exchange was granted the right to pay its critical vendors up to $8.5 million upon its chief executive officer approval. And this is the story we have to watch, is Genesis. It says here, Genesis received over $1 billion worth of FTT from Alameda FTX in the last 3 months. You know, if Genesis falls, expect crypto to drop.
We're looking at crypto brokerage Genesis because it has been scouring the globe for at least $1 billion in fresh capital for its lending unit, and it's privately warning investors that it might become the latest casualty in that it might have to file for bankruptcy if that funding doesn't materialize. Now, it's unclear how fast the liquidity crunch causes more companies to fall, but so far, there's been some real damage done really quickly, and the warning from Genesis to investors has only come days since the company's trading arm announced more than $170 million tied up in FTX. The lending business has halted withdrawals within a week, spurring its lending partner Gemini Earn to halt withdrawals as well. Now, let's move over to FTX, because as the bankruptcy proceedings begin in Delaware, it's just one example of how many people are owed money in one instance of a bankruptcy. More than 1 million customers had funds tied up, and more than $3 billion were owed to 50 creditors, including Genesis. Now, in the case of FTX, a lawyer for the company said that during a bankruptcy hearing on Tuesday that while crypto crisis is well documented overall, the FTX drama is the latest and the largest failure with effectively a run on the bank with respect to international exchange as well as its U.S. exchange. Investigators, lawmakers, and regulators around the world are now watching how this plays out to make sure their customers find some redemption.
Yeah, so regulation is coming. New York's mayor seeks balance with regulators after proof of work mining moratorium. New York is still focused on becoming a crypto hub, but statewide efforts to reduce emissions can be combined with this goal. And SEC chair's crypto oversight strategy in question as ecosystems collapse. Congressman Tom Emmer showed concerns about the oversight strategy implemented by Gary Gensler, the chair of the U.S. Securities and Exchange Commission for the crypto ecosystem, and crypto adoption via regulation, setting rules for centralized exchanges. While some security issues do exist, major internet outages like the one witnessed across the EU recently cannot really threaten cryptocurrencies or their associated networks. And the FDIC acting chair says no crypto firms or tokens are backed by agency. Martin Gruenberg answered affirmatively to Senator Bob Menendez that there were no cryptocurrency firms backed by the FDIC, and its coverage did not include crypto of any kind. So let's take a quick listen on what they're saying about regulation on the news.
Next, Kyle Davies, the co-founder behind defunct crypto hedge fund Three Arrows Capital, is also speaking out in the wake of crypto's latest crisis, and he's partly blaming Sam Bankman-Fried for 3AC's collapse. In an interview with CNBC this morning, Davies claimed FTX hunted 3AC's positions. A bipartisan group of House Financial Services Committee members will hold a hearing in December where they plan to grill executives from the crypto exchange, along with Alameda Research, Binance, and others. In a statement, Representative Maxine Waters said, quote, "The fall of FTX has posed tremendous harm to over 1 million users, many of whom were everyday people who invested their hard-earned savings into the FTX cryptocurrency exchange, only to watch it all disappear within a matter of seconds." Unfortunately, this event is just one out of many examples of cryptocurrency platforms that have collapsed just this past year.
SBF, as he's also known, and his companies poured billions of dollars of liquidity into the space, bailing out businesses like BlockFi and Voyager Digital. As recently as August, SBF told CNBC that FTX had $1 billion in cash to deploy at any given moment.
It's not going to be good for anyone long term if we have real pain, if we have real blowouts, and it's not fair to customers, and it's not going to be good for regulation. It's not going to be good for anything. From a longer term perspective, it's just that was what was important for the ecosystem. It's what was important for customers, and it was what was important for people to be able to operate in the ecosystem without being terrified that unknown unknowns were going to blow them up somehow.
It seemed like SBF had become the white knight of crypto, the lender of last resort for an entire industry. And for a while, things were looking up. The price of Bitcoin and other cryptocurrencies leveled out, and developers continued to build new projects. But now, nearly 6 months to the day after Terra Luna collapsed, FTX has filed for bankruptcy protection, and Sam Bankman-Fried faces investigations from U.S. regulators and potentially the Department of Justice. So, what went wrong? On November 2nd, a report published by CoinDesk found that Alameda Research, a trading firm launched by SBF to trade thousands of digital assets, was heavily invested in FTX's own token, FTT. After the report, Binance CEO Changpeng Zhao tweeted that the company would be selling its FTT holdings due to, quote, recent revelations.
Then there was this whole kind of back and forth over Twitter between CZ, who runs Binance, versus SBF.
But that didn't last. A short time later, Bankman-Fried tweeted that Binance had reached a deal to acquire FTX, did about a day of due diligence looking through FTX's finances, but Binance reportedly didn't like what it saw and backed out of the deal just a day later. With few options remaining to save the company, on November 11th, FTX filed for bankruptcy protection, and Sam Bankman-Fried stepped down as CEO. A report from Reuters found that the exchange was transferring billions in customer funds to Alameda Research to shore up the trading firm's business. Sources told Reuters that a large portion of that money disappeared and that top executives had bookkeeping backdoors to prevent some of those transfers from being noticed.
It's likely that they were starting to have issues in June, and maybe they were actually more wrapped up in the Luna and Three Arrows debacle than they let on. And either FTX had a hole because of that, or maybe Alameda had a hole because of that. And one was used to plug the other. That's the only kind of reasonable way that we can assume that something to the tune of $10 billion goes missing.
Those transfers went unnoticed until customers rushed to withdraw funds amid uncertainty over the company's finances.
When you're running in a fractional reserve process, withdrawals are actually the thing that start to pull your lifeblood away.
So after the collapse of one of the most trusted names in crypto, Where does the industry go from here?